Great. Good morning, everybody. Welcome to Attract Capital's webinar, The Lending Game, What is Mezzanine Debt and How Can It Help Me? This is David Barnett next to me.
Hi, everybody. How are you today?
My name is Jonathan Davidowitz. I hope everyone is doing well. All right, Dave, let's get right into it. So what is mezzanine debt?
Mezzanine debt is a form of financing. It's not widely understood in the market, but it's a loan that you get from a funding source that's much different than a bank loan because it's based on the cash flow of a company. So it tends to be much larger than a bank loan. But what's really unique about it is that you can get more money and you can do more with it. And you can almost do as much with a mezzanine loan as you can if you got money from an investor. So it's a very flexible form of financing that a lot of companies really don't know about.
So what makes it different than a bank loan? What are the differences? Speak towards that point.
Sure. Well, John, with bank loans, most bank loans are based on assets. So if you have receivables, if you have inventory, if you have equipment, you can get a loan against the collateral value of those assets. Mezzanine lenders look at the world very differently. They look at the world sort of like how stock market investors do. Stock market investors look at a company's earnings and they will value a company based on a multiple of the forward earnings. That's what mezzanine lenders do. Mezzanine lenders, they look at the EBITDA of a company and they'll put a multiple on that EBITDA and they'll size their loan according to a multiple that they're comfortable with. So it's very simple math, John. It's usually 3 times to 4 times a company's EBITDA is the loan size that they're comfortable with. And if you do the math, on most companies, the loan that is sized based on a multiple is generally much larger than a loan that's a fraction of a company's collateral value. So it's sort of a pretty compelling difference between a bank loan in terms of the amount of money you can get.
Okay. So now our followers on the other side of the camera are, they hear the word mezzanine debt, mezzanine finance. Why is it called mezzanine? Explain what that's about.
Well, if you've ever gone to a sporting event or a Broadway show, there's a mezzanine level. There's the orchestra, and then there's usually the upper deck, and there's the mezzanine. And if you've ever sat in the mezzanine, you would know that it's in the middle of the stadium or it's the middle of the concert hall. So what mezzanine financing, it gets its name from the fact that it's generally in the middle. It's sort of the middle layer of a 3-layer cake, if you will. And on top of it, you have the bank loan. So the bank loan is in first position, and it's generally a loan against the assets of the company. The third layer is the investor, the equity that an investor would put in the company or the equity value that a company has built up on its balance sheet. That's the bottom layer. So the middle layer, which is sandwiched between the bank loan and the investor equity, that's the mezzanine layer. And that's really that's a layer of capital that's based upon the cash flow value of the business as opposed to the asset value, as we spoke earlier. So it's got an interesting name, mezzanine, but it's really, if you think about it, it's in the middle of the equity in the bank loan. But it's at a level where it can really make a big difference to a company because it can give that company that extra bit of financing. It can fund the gap when a bank won't be willing to.
So we understand what exactly it is and where it comes from. So now, how are these loans structured? What is the way that, if I want some mezzanine debt or need some capital, what is the best way to go about it and how are they going to be structured?
Sure, that's a good question. So as I said earlier, the mezzanine loans are typically structured as a multiple of EBITDA. The one trick or the one unique aspect is that they're generally structured off of pro forma EBITDA. Now, pro forma means that you look at the historical EBITDA and you come up with anything that might have been one-time, non-recurring adjustments so that you basically will come up with a number that is a number that you think the business will generate in the next year, sort of a future EBITDA based on what the historical EBITDA was. And what's interesting is you're able to build the loan off of this pro forma number. So to just pick an example, let's say a company has $2 million of EBITDA for fiscal 15, but they had $500,000 of adjustments. You could structure the loan off of $2 million plus $500,000 or $2.5 million. So it really opens up a lot of additional loan availability when you structure the loan this way because you're putting a multiple on top of a pro forma EBITDA, and it means that you can get an extra, if you're using a 3 multiple, you can get an extra $1.5 million. So it really opens up the availability.
Okay, so I'm a company sitting on the other side of the camera. We hear all the financial information. What kind of company is suited for this? Can it fit my company? And if so, how can it help my company?
I think it could fit any company. I think the companies that do best with it are cash flow rich companies who are asset poor. What I mean by that is that companies that have a high return on invested capital, where they generate very strong EBITDA, they have good gross margins. These are companies that can benefit from this. We work with a lot of companies that, if you look at their borrowing capacity just solely against their receivables, there's not a lot there. But when you look at their EBITDA, they have very strong EBITDA. So usually companies that are not working capital intensive, companies that do not have inventory, companies that don't have a lot of equipment, these are the companies that do really well with a mezzanine approach. To give you a few, I'd say business services, healthcare is very popular, technology is popular, manufacturing, high value added distributing is very popular. These are just some of the companies that have been successful with mezzanine financing over the year.
We have a question that just came in from Jack Beam. How would you distinguish a line of credit from mezzanine financing?
Sure. Well, Jack, a line of credit, that's a good question. A line of credit is a bank loan for the most part. Banks provide, or finance companies or factoring companies provide lines of credit. And a line of credit is simply a loan against the collateral value of the assets on the balance sheet. So typically it's an 80% of receivable or 50% of inventory advance rate. So you tend not to get a lot of money. So if you're looking to do anything big, if you're looking to do an acquisition, you're looking to do some serious business expansion, if you're looking at getting into another part of the country, if you're looking at hiring a new sales force or to do some additional product development, a line of credit is not going to give you the money that you need to be able to do that. Most companies use their line to help them manage their working capital fluctuations on a week-to-week, month-to-month basis. But if you're looking to do serious development, if you're looking to do serious growth, mezzanine financing is really more like a term loan because it's generally a 5-year loan. It's interest only. So it gives you the money you need so you can grow your company over the next 2 to 3 years so that it's much larger and much more valuable.
So now Jack and I have decided that we want to make a serious investment in our company.
Okay.
So how large of a loan can we receive, and what will it cost me to get that kind of loan?
Sure. Well, the loan sizes in mezzanine are very variable. They usually start at the $3 to $4 million level, and they can go all the way up to billions of dollars. And typically, the structures, the interest rate is in the low teens, so 10, 11, 12%. Most mezzanine lenders, John, are looking for a blended annual return between 14 to 16%. And the way they get their blended annual return is partially through the interest rate that the company pays, as well as partially through some additional upside called a warrant. So they'll take a very small warrant position in order to get to that higher blended rate. So it will cost you every year, the interest expense will be about 11, 12% on the loan. It'll cost you money up front with a small fee, a closing fee, and you'll give up a small warrant position, which means they're getting additional upside based upon the future value that's built up in the company. But if you think about it, what's really neat about mezzanine financing is that if you structure it properly and if you present the EBITDA of the company properly, you can pretty much use this mezzanine loan as an equity substitute. So for example, John, if you were going to buy another company, let's say Davidowitz Inc. wanted to buy Jack Beam Inc., and in order to buy Jack Beam Inc., you needed $10 million. Well, the normal way to come up with that $10 million is for you to put in $2 to $3 million worth of equity and then try to find a bank loan for 7 or 8 million. And then whatever you can't get from the bank, you would go to a mezzanine lender for. The way that we propose to finance these deals is to do it all with mezzanine. Because if you bring in 2 to 3 million of equity, you're going to give up 60, 70, 80% of the equity to the investor that's putting in the money. So you're losing control, you're giving up a huge percentage of the equity. And with mezzanine, you can get pretty much the same level of money that you can get from an equity investor, but you're only giving them an interest rate and you're giving them a small warrant. So it's a great trade.
Great.
We have a question from Steve N. You didn't mention restaurants in your list of businesses. So what about that industry?
Restaurants, we've actually worked with some restaurants in the past. See, the issue, Steve, with restaurants is that a lot of times they tend to be very real estate based. So it depends on if they own their brick and mortar, then they tend to have a lot of mortgage debt in their balance sheet. And so it doesn't fit as easily into the multiple criteria that I just recited for you. We have worked with some restaurant chains. We've worked with other retail chains. We raised mezzanine financing for one of the country's largest chain of tanning salons. This was many years ago. This was a very profitable company. They didn't own any of their real estate. They were more like just a true retail company, and they had leases with their landlords. So if you lease your real estate in the restaurant business, then it's something that could be possible. And there's a lot of people that look at restaurant deals out there. But if you own your real estate, it gets a little trickier.
Okay, Dave. So everybody behind the camera wants to know a little bit more about you. So how long have you been involved with mezzanine loans?
John, I've been doing mezzanine loans longer than you've been alive, which is to say a long time. Let's see. I started in the mezzanine world in 1990, right after I graduated from Columbia Business School. And I worked at a company there called GE Capital, and they were one of the pioneers. They did one-stop financings. And then I joined a company called Grey Rock Capital, where they did one-stop financings, and mezzanine was the central part of what they were doing. So I've been doing it for 26 years. A lot of deals, all of them have been middle market. I want to say they've all been, say, 5 million deal size on the low to 100 million deal size on the high, probably 120, 130 deals. And so we've been doing it a long time.
Okay. So now, what's the best experience that you have had? Give some examples to everybody out there of maybe a good experience and a bad experience that you've gone through and how you've dealt with both.
There's no bad experiences with mezzanine, John. Silly guy. Okay, so there's a client that we had. It was a company from the United Kingdom. The company was called Tensator. They made queuing products, barriers, crowd control barriers. They were out of the UK. They came over to New York and they wanted to buy their distributor. And it was a nice company in the UK. They didn't have any equity money to put into the New York company that they wanted to buy. So we helped them bring in 100% of the deal was financed. And basically, our client, he rolled the value of his company into this acquisition. So his company might have been worth at the time maybe £2 million tops. We were able to raise him about $30 million in financing. And what he was able to do is he was able to take his company, which was doing maybe 2 million of EBITDA. He was able to grow it to 8 million in EBITDA. And he sold it for like $80 million.
That's amazing.
So it was like a 30, 40 times return. And the key to it, and the key to mezzanine financing is that he did not have to put cash equity into the deal, nor did he have to bring in cash equity from an investor. So he wasn't diluted. Because when you get diluted, you give up a huge amount of shares, and you're going to give up value when you sell the company. So our client held on to all of his shares. He gave up a small warrant to the lender, and he basically parlayed a company that might have been worth 2 million into a company that was worth 80 million when he sold it.
That's amazing.
We've got another question from Steve. What is the minimum loan transaction that you get involved with?
I'd say, Steve, it's 3 to 4 million because we go to institutions. We go to the various lenders that are in the market, and they tend not to be interested in loan sizes that are lower than $3 to $4 million. They're looking for companies that generally are doing between 20 million and 100 million in revenue, where the EBITDA would start at about $2 million. That $2 million of EBITDA is kind of a minimum threshold for a lot of the lenders. So that's why we say if the company's doing 20 million of revenue, 2 million of EBITDA, the starting ticket size is about 3 to 4 million on the mezzanine side.
Okay. So Dave.
But John, I did not
Mhm.
give you a negative experience,
Mhm.
but there are negative experiences. But let me tell you why mezzanine is still good even in a downside case. Um, Not every company's business performs according to plan. There's a lot of problems with companies can have management issues, they can have industry issues, they can lose customers, anything can happen. What mezzanine, because it's a loan against the cash flow of the business and not the assets of the business, mezzanine lenders are not trigger happy when it comes to accelerating their loans, to squeezing the owners of the company, or to basically calling a default and trying to liquidate the company. They're much more patient. So if you have a problem, let's say your company loses a big customer, or if you have a problem in the industry and margins really deteriorate, mezzanine lenders are really good in that type of a downside scenario because they're going to be patient. As long as they think the management team is focused, that they're engaged, and they're trying to work through their problems, they'll usually hang in there with you. As opposed to a bank, where banks are just like, accelerate the loan, let's liquidate the collateral, let's get what we can out of it, and we'll call it a day. Mezzanine lenders will usually work with you during a down cycle, and that's why it's sort of a mezzanine lender. They provide more value than an equity investor. They only have one way out. They have one way out, and that's through the cash flow. And they're very reliant upon the management of the company to generate the cash flow to take them out. So I think it's a win-win all the way around.
Okay, great. So before we end here, what is one final piece of information that you would give everybody out there that you think is the most important thing that they should know?
The one piece of information that's the most important thing that they should know. You have to have, as a company, you have to have good financial statements. You have to have reviewed financials or audited financials, and you have to really know what your EBITDA is and understand this whole process. I mean, what I'm talking about here is I'm sort of distilling 26 years worth of industry experience into a 15, 20-minute webinar, but there's a whole process and there's a whole estimation and there's a whole management of a process that goes into bringing in this type of financing. You want to work with somebody who understands the market, somebody that can help present your company and can structure the loan and can bring you to the lenders and has credibility in the market. So what I would say to you is the one thing is that you want to work with an expert and you really want to have good numbers. That's probably two things, John, but I think it's an important second thing for people to know.
Okay, great. That's it for us here today. Thank you, Jack and Steve, for asking some great questions. Thank you, Sonia, as well, for staying behind the camera and reading them to us. If you guys have any more questions, visit us at attractcapital.com.
Are there any?
Is there anything else out there right now?
Elliot just wrote, Elliot, I'm not sure if that's your full question or not, but it just says Q. So
Okay.
if you have another question, oh, he's typing.
Great.
Okay, we'll hold on for you.
Yeah, definitely.
When is the next webinar? Have we
I
set
think we
that
have
up
it
yet?
sometime in mid-July.
In mid-July.
Yeah,
Okay.
so it's in mid-July, and we're also going to be posting this. We're going to be sending everybody a link, and we're going to be posting this on the website so you can access this information. But the mezzanine market is strong right now. So if you have a company or if you're a broker and you know companies that are looking for acquisition financing or growth financing, you should really just mention the word mezzanine to them. Go on Google, come to the website, send us an email, and we'd be happy to give you information. We have a lot of information, and we're always talking to people, and we're happy to be a resource to help people become more educated on mezzanine. Sonia, did Elliot type the question?
No, he's still typing. And don't forget, everybody, you can also watch us live on Facebook, and all the webinars will be uploaded to Facebook, so you could visit them and revisit past webinars anytime that you would like.
So while we're waiting for Elliot's question, John, John is moving on. John is going to be moving on to the next stage of his career, but you've learned a bit about mezzanine financing. So what do you like about mezzanine?
What I like about mezzanine is it's a great opportunity for mid-market companies to find their way to, I guess, find the most development and growth from it. So if you go onto the website, I've wrote a couple articles and Dave has about the ways that mezzanine can be used to help your company, and the way that you could find potential growth and areas where you might not even realize you could use mezzanine growth in. So it's a spectacular opportunity. And I think Attract Capital does a great job of reaching out to everyone out there and, informing them exactly what mezzanine is and other options as well that they could use to finance their company and find, development and grow from there.
No, I would agree. I think John made a really good point. There's no limit to how the capital can be used. You can use it for equipment, you can use it for acquisitions, you can use it for market growth. In fact, there's probably a whole number of things you want to do with your company in order to take it to the next level. And mezzanine can be used for any single one of them. The lenders are very flexible. They're very big picture. They're not like a bank. They're not looking to restrict you. They're looking to empower you.
Okay, so Elliot asks, would you do a deal if the FS are not audited? I walk out of a deal because they refuse to audit.
So we've actually done deals, Elliot, where the financial statements were not audited. However, if you're buying a company that's not audited or even reviewed, let's say, you need to do more due diligence internally on that. You need to bring in your accounting firm. They need to do what's known as a quality of earnings review. And that will, in the eyes of some lenders, compensate for the fact that the company isn't audited. If the company isn't audited, though, if the company isn't reviewed, it's usually an indication that they may not take financial reporting as seriously as a company that would be audited, which could mean that they are not as good at projecting profit, they're not as good as budgeting, they're not as good as measuring. So it can be an indication that the company might, if you commit to a deal process, there could be some uncertainty as to how the business trends once you're in the middle of the deal process. We work with a number of companies that weren't audited. We always find that somehow they lose track of where they are in their numbers. They start underperforming, and then what can happen is the deal unravels. So it's always better to look for a company that has some financial statement discipline internally.
All right, great. So I think that's it for today. Again, visit us at attractcapital.com, or as well as Facebook as well. You can find us. You can just follow us if you just type in Attract Capital, and you'll find us right there. If you have any questions, again, visit the website, and that's it for me. Thank you.
Have a great 4th of July, everybody.